Good afternoon or good morning. Good morning, good afternoon or good morning, depending on where you're joining us from. Welcome to our webinar, Buying and Selling a Business in Canada. Items so you participate in the webinar. You should see something that looks like this on your screen in the upper right corner. As we have a big group today, your audio is muted. However, you can submit text questions through the presentation by typing in the question pane of the control panel, right beside the big red arrow. Your questions will be answered during the Q&A portion of the session. I also wanted to let you know that CPD certificates, as well as a recording of the session, will be sent along by the end of the week. Leading today's webinar, we are thrilled to have Michael Henry, Managing Partner of Hauser, Henry & Siren. Michael is an innovative and entrepreneurial leader who thrives on working differently than most law firms to deliver a more client-focused experience. He and his well been from complex legal challenges to grow and to manage risk successfully over the long term through a uniquely collaborative approach. Michael specializes in M&A deals, reorganizations, shareholders disputes and agreements, corporate financing, as well as commercial agreements and employment contracts, and succession and estate planning. Michael also advises trust companies and trustees on estate administration. We are pleased to be joined by Morris Swimmer, Senior Lawyer, Commercial Law Real Estate with Spiegel Sommer, and Mark Wong, Business Lawyer, Corporate Commercial and Commercial Real Estate with Kaufman Califf. And now I'll hand things over to Michael to start the presentation.
Good morning, or good afternoon, and thank you, Kaija, for that introduction. We're delighted to be speaking with you today, and I want to thank everyone for taking time to join us. I'm joined this morning with two panelists, Mark Wong in Vancouver with the firm of Kaufman Califf, and Morris Swimmer with Spiegel Sommer in Montreal. I'll just take a moment to give them a bit more of an introduction. Morris Swimmer is a senior lawyer focused on commercial law and real estate law. He's a senior member of his firm's commercial law group. His practice focuses primarily on private mergers and acquisitions, working closely with entrepreneurs locally, nationally, as well as in connection with their cross-border requirements. Besides his clients with street-based finding legals that make solid business sense, he's gained the confidence and status of a trusted advisor from many of his clients. Most of them have counted on his sound advice and service for over 3 decades. In Vancouver, we're joined by Mark Wong, who is a business lawyer focused on corporate commercial and commercial real estate with the firm of Kaufman Califf. Mark advises his entrepreneurial-based clients in commercial business matters. His experience includes acting for vendors and purchasers in mergers and acquisitions transactions, acting for vendors, purchasers, landlords, and tenants in real estate transactions, advising on intellectual property and technology issues, advising on lending, borrowing, and leasing transactions, and generally providing a business and legal resource to his firm's clientele. Mark's a member of the Vancouver and Canadian Bar Association, the Law Society of British Columbia, the Vancouver Board of Trade, and the Hong Kong Canada Business Association. Our focus today is on private companies, and so we are going to be discussing a range of issues. And we decided to focus on 3 essential aspects of a successful transaction. And the first is people, Mark will talk about that. And the second is planning, and I will speak on that point. And thirdly, it's process, and Morris will talk on that topic. If you look at the general record of most M&A transactions, some big, some small, frequently, unfortunately, the transactions do not take shape as the buyer and the seller would like. And the reason for that, I think, is that these critical aspects are overlooked or undermanaged. And so our hope today is to provide you with some practical insights on what's transaction, buying and selling a business by focusing on people, planning, and process. This is intended to be a discussion, and as Kaja mentioned, there's the opportunity to already got some questions that were submitted before the seminar today, and so I welcome your comments and suggestions, and we'll do our best to answer and address those throughout this presentation today. So at this point, I'd like to turn it over to Mark Wong in Vancouver to talk about people and how that's an important aspect to buying and selling a business.
Good morning, everyone. I can still say good morning from Vancouver. Michael's laid out for us some basic topics, but they are core to any transaction. And from the people aspect, it comes at it from a couple perspectives. People are important for understanding their motivations for why they're in the transaction at all. They're also important to understand, are they actually the value proposition for the transaction, or is it merely about revenue? But that revenue only comes from the good work of people. So no matter how you look at a transaction, whether it's a share purchase or an asset purchase, the people are going to underline and be the central element that we tend to forget about while doing the transaction. So if we don't understand what's happening amongst the people, we're going to have a more difficult time putting that transaction together. So when you look at us as advisors, whether we're an accountant, whether we're a lawyer, there's dozens of us out there who can do exactly the same thing. But what's going to make the difference is whether, as Michael described it, we can actually get a successful transaction and do it in a way that is effective for everybody. So in my view, our role is about going beyond our core competencies and being able to have some anticipation. And that comes from trying to understand the perspective and motivation of each party that's involved. One thing I often say to my clients is that the best deals are where both sides leave the transaction feeling a little unhappy. Now that sounds counterintuitive, but if you think about it, the point is that nobody feels like they got taken advantage of. We each got something out of it, and we each didn't get something we wanted. And is that a balancing of potential bargaining power? Potentially, but it's a key to a successful transaction that nobody feels that they get taken advantage of. So we've got some headings that we can talk about: dynamics between buyers and sellers. So let's talk about that. Is this a transaction that your client really needs? So there's a desperation factor, perhaps, if we're the vendor here. And part of the angle that you need to understand is, well, how quickly do we need to get the deal through? How much time pressure is placed upon us? And then that leads into another aspect. Is your client detail oriented or not? So if we have these kinds of issues, and I'm going to start from the seller side, that if there's all kinds of time or financial pressure on a transaction, that's going to motivate our seller to do things a particular way. The other aspect is it could be for other reasons. This could be a retirement or succession issue. And if that's the case, there needs to be an analysis of who's actually available to be in that succession role. And that comes back again to understanding the seller's motivation for doing that kind of transaction, and whether there is a heir apparent, or even with internal approaches of their senior management or people that are available to do that kind of transaction. So many times, if it's early in the process, clients will come in and they actually don't know what they want, but they know they need to move on some basis. So that is part of our role as an advisor, to try and help and fit that into the appropriate scope of the transaction. So if you sit and you do it from the buyer side, well, why do I need to be a buyer? There's many reasons for acquisitions, and if you want to be Wall Street about it, it's just a drive for more EBITDA or earnings per share, and that's all we care. We need some more dollars on our bottom line and add to our aggregate, and that's very much the case for some of the purchasers out there. Some are looking to dominate markets, market share, and that's another point of trying to understand, or they're just trying to take out a particular vertical in an industry. So if we start out understanding what their motivations are, at least we can defend ourselves if we're the seller, or if we're the purchaser, we can orient what our due diligence is going to be, and we can push from that perspective. Now, having said all that, it's also looking at the individuals that are involved. Are we going to be, I call it an alpha versus committee. Am I going to be dealing with an entrepreneur who can give me an answer in about 15 seconds to most questions? Or am I going to have to wait 3 days in dealing with a committee process where they're going to go speak to the CFO? The CFO is going to check with 2 of the middle managers. And what kind of time frame is that going to mean to run this transaction? As an advisor, we need to be prepared for those sort of circumstances and be in a position to try and address that and to push it in the right direction. The other issue is the aspect of, is this a slam your hands on the table, take it or leave it kind of negotiation, or are we going to quietly die from the death of 1,000 tiny paper cuts? And those can be very tedious transactions to do. Some lawyers think that they've won something by dragging out a transaction, but that has to come back to understanding your client. What is your client prepared to do? Is it a negotiation tactic? But those are the kinds of perspectives that you need to start with to try and understand. So if we get a sense of what our buyers and sellers are like, well, why are they behaving that way? Well, think about it as a seller. It's our motivation here to be to get the maximized price. So we're going to do everything that we can do to get the biggest amount of dollars into our jeans. That also calls into question the way as they are, as I call it, having to open the kimono to a purchaser. They're going to get very defensive of past practices. They're going to be very concerned about past accounting practices, methods of doing business, and all of that's got to be laid out on the table. So knowing that, you have to, again, coach your client, try to identify what it is that's appropriate for them to put forward, and be upfront about it. It's often their protection of their baby. But you look at it from the buyer side, and it's entirely opposite. They obviously want to pay the minimum price, and they are looking for the so-called skeletons in the closet. And it's that attention to detail that's going to come from the other side that's going to try to break down every account, look for every possible litigation that could be out there. And that's also driven by particular industries and particular risks where litigation can arise. So the seller has different goals, and the buyer is going to be generally risk averse. So again, it's navigating that balance and explaining to our clients, whether we're buyers or sellers, this is their motivation. This is why we have to do certain things. And this is also where Morris and Michael will carry on with the other elements of our talk today. But the other elements are the employees. And I started to talk about that as I began. Employees are more often than not the enterprise value proposition. A simple example, we have a lot of high-tech industries out here, and more times than not, if we're doing an acquisition in that space, they often don't care what the product is. We need more people into our studio. We need more consultants and technology people, and it's based on the size of your lab. They almost don't care if you have revenue or not. So if that's the type of transaction, again, you need to understand how important that is to the transaction. The other issue is, what's often overlooked is, who are the core people that are going to be left behind, or the core workforce. There should be an analysis done of the management skills, typically starting with the financial, but there could be a very strong portion that's tied up in engineering or product development. And again, this is to understand what is the nature of the business and what is going to be key to adding value to the transaction. And some of this will follow from the size of the enterprise. If we're dealing with a very small transaction and it's entrepreneurial, we'll have a different sort of attitude. If we're dealing with a larger environment that's perhaps even unionized, which can sometimes be more difficult or simpler depending on the scope of the union contract, you need to take those considerations into place. But every business can't continue operating unless you're planning to shut it down, unless we have employee retention. So the messaging that goes out to the employees is almost critical, and it has to be done at the right time. You don't want to do it too soon to give anybody panic about their futures, because look, this is everyone's livelihoods that you're playing with. And so again, you need to be sensitive about the message that goes out. The final concept you need to be careful about is dealing with founders. More often than not, you are going to have some sort of consulting arrangement in which a founder will stay on, at least for a period of time, for a transition period. The question becomes, is it a good idea to keep the founder in? And what is the reason to keep the founder in? The letting go of the baby, to start out with my original comments, that can be both a problem and a potential benefit in terms of getting transition scope in from the parties. And that needs to be planned for to see just how important that is. So our role as advisors is to bring all those elements together, try to understand who we're dealing with, and then find a way to put this whole transaction together. So that's why we've clearly identified that people are a very key element that need to be addressed right at the beginning. I'm going to conclude my comments there and pass it back to Michael and Morris to see if there's any other comments from you.
Thanks, Mark. The one comment I would make is sometimes and no one's ever going to change another person's personality, but sometimes in transactions there's quite a bit of ego that comes forward, and it sometimes has to be navigated depending on the parties and the dynamic between them, and it can lead to some difficult moments and maybe some expensive detours, but it's something to be aware of, that personalities in the actual, and ego in the actual transaction can have some important consequences, and has to be managed as well.
The one thing I could add to that, I've actually done transactions where the buyer and sellers never speak.
Great, thank you, Mark. Successful deal that we wanted planning. Really? That would be challenging, I think. And what are the elements of a successful plan for the buying or selling of a business? I'm going to focus mostly on the selling. So as a note, planning, and I think the central for successful transaction is whether the owner of the business, so that central question is whether the business owner is ready and willing to change. And if the answer is yes, then the transaction can go forward. But if the owner is unwilling or unready, as Mark mentioned, founders often struggle to let go of their baby. the enterprise they've built over probably many years, and after enduring all sorts of sacrifices and seizing opportunities, suffering setbacks, there's a lot of emotional challenge in letting go. But the elements of a successful plan, I think, are four. And the first is to start early. Usually business owners don't, and they wait until they receive an offer, and it's very exciting to receive an offer to sell a business. But it's a mistake to believe, and as advisors, we need to counsel our clients that selling a business quickly or simply because there's been an offer to buy it can often lead to some headaches. The second thing is to assemble a team. It's often difficult to run a transaction and run a business at the same time. So having a team of advisors is an essential part. And thirdly, there need to be clear and realistic goals, including personal goals, because as we've talked, if it's a founder who's selling his or her business, that person needs to plan for life after the business. And fourthly, I think a good plan stays focused, but it's also flexible. As I mentioned, it can be flattering for a business owner to receive an offer to sell a business. Owners are often very keen to know what's the value of my business. And as advisors, we're often asked, and accountants would often be asked the same question, what's my business worth? I think the reason for this is because being a business owner is often a lonely endeavor. And owners are often looking for some ratification, maybe some justification for the sacrifices that they've endured and the time they've spent building a business. Has it been worth it? What's the value of the business now? But as I mentioned, the key question is whether the business owner is ready and willing to sell. And if he or she is, then we can have a discussion about how to prepare a business for sale. But as advisors, lawyers, or accountants, we have to be mindful of this struggle sometimes inside the minds and hearts of business owners. And I often see a fascinating contrast between the boldness of entrepreneurs who are disrupting businesses, taking risks, seizing opportunities in their business life, and yet in their personal life, they have a reluctance to prepare for change. And instead of preparing for change, they often procrastinate, or they begin a plan and then they don't follow through. We see that as well. And sadly, in that scenario, it becomes a waiting game, waiting for problems to accumulate. And it might be the loss of a key customer, health issues in the owner, a downturn in the economy, could be a legal fight, any of those things. And when they do occur, they often overwhelm the owner. And then sadly, the owner might be just exhausted or fed up enough to say, I need to sell this business. At that point, as advisors, I think this is our worst case scenario, because the business is often sold for a discount, or even worse, it's closed. And the value for all that investment over many years is lost, or it's greatly diminished. So it's very important to gently, as advisors, challenge the owner as to whether he or she is really ready to let go, and if so, to prepare for the sale of the business. Another essential element to a good plan are clear and realistic goals. I start this section by talking about price. Price is an essential framework for any deal. And business owners, as I said, sometimes working in isolation, often don't have a realistic view of the value of their business. And so it needs to be anchored in some analysis. And while it may not be appropriate to have a full-blown evaluation done, it is helpful, I think, to have some sense of how the market sees and would value the business. And also, there may be non-monetary goals. There may be goals such as employees. We've had a client sell a major business, a family business, for many years last year, and the fate of the employees was a critical concern. Our client looked for a buyer that would take on many of these employees, some of whom were older and long service with the company, and not terminate them. And so that meant that our client chose a buyer that may not have made the largest financial offer on the price, but had a definite and and supportive plan for the employees. As I mentioned before, another critical aspect to a good plan is assembling a team. It's very difficult to run a business and run a deal at the same time. And sometimes with business owners and mid-market private companies, they don't have the depth of management so that they can confidently delegate and manage discreetly the project with someone else inside the organization. And here's where outside advisors can help, lawyers or accountants. We can help clients navigate this process and take some of the burden of the transaction off their shoulders. So once a decision is made, a team is assembled, goals are fixed, the next step is to prepare the business for sale. Because as I mentioned, most businesses are really not ready for sale at any given moment. Now, I want to be clear here that every business is a work in progress, and there's no perfection among any of us. But usually there are things that a seller can do to prepare a business and ensure that it's sold for its optimal value. And that might be, for example, dealing with environmental concerns. We had a client who was selling a lot of real estate that had been used for an industrial purpose. And the client did some environmental investigations, but probably should have done some more because the environmental aspects of these properties became a big issue in the subsequent sale. And some of those, and it's not necessarily, I'm not suggesting that all of these issues can be resolved, but at least they can be identified and understood better. It could mean settling some litigation or bringing in new management to provide for greater depth, or selling an unproductive asset or an unprofitable line of the business. In any preparation of a business, the owner has to look at the business as a buyer would, with the same kind of cool detachment that a buyer would have, not thinking about some sentimental attachments to a location or to a certain business line or business aspect, and imagine what is the best way to maximize the value. That process of preparing a business for sale can often take 1 or 2 years. Another important part of it is making sure that the structure is correct, that the corporate and tax structure is appropriate, that records are up to date. Ultimately, as the seller approaches the transaction, the buyer will typically, and a letter of intent is usually signed, or a confidentiality agreement, the buyer will present a due diligence request. And this is usually a 6 or 7 page memo that has a laundry list of items. And as advisors, we're often asked to look at them, and sometimes it's overwhelming, frankly. List of assets, list of employees, list of insurance, list of financials, compliance, tax, all sorts of information. It'll depend slightly if it's an asset purchase or a share purchase, but it's usually a laundry list in any case. And if the seller can respond to that request, which we know is coming, with a crisply organized package of disclosure documents, then it conveys and it gives the buyer confidence that the seller is an informed owner. We had a transaction a short while ago in which the client had certain issues with the business, and unfortunately it took quite a while for the buyer to be confident that the seller really understood all those issues. It's not that the seller wasn't experienced in business, it's just that it took for granted some issues, some problems with the business, and it simply put up with them rather than imagining what a buyer would expect. So preparing for the response to due diligence is an excellent opportunity to demonstrate confidence and knowledge in the business. And that supports the argument for usually a higher price on the seller side. Now, I focused on sellers, but buyers need to plan as well. And usually the buyer's planning has to do with the structure of the transaction and then what will happen to the business afterwards, after the closing. How will it be integrated? How will it be grown further? And I've often had clients approach me and say, well, how do I find an opportunity? I'd love to buy a business. Where do I go? And there are one-page teasers, brief descriptions of transactions that filter through with M&A advisors or investment bankers. And there are descriptions of opportunities. But frankly, I think the easiest way to do it is by, if there is an interest in a particular industry, to try and get close to that industry. And the closer people are to a certain industry, the more likely they are to hear about someone retiring or selling or having challenges or looking for a change. And that, frankly, word of mouth seems to be one of the easiest ways to find opportunities. So once a buyer's identified an opportunity, an important question also for the seller, but with the buyer as well, is whether to buy assets or shares. And the advantage of buying assets is the buyer gets to pick and choose those assets that it thinks are most valuable or most compatible with its business. Buying shares means that the buyer is buying the whole business, all of its history, good or bad, its tax position and the rest of things. So it requires a deeper due diligence. But usually sellers want to sell shares for the capital gains treatment they'll get. Buyers will also want to think about financing, how that will be arranged. Will it be a vendor take back? Will there also be an adjustment to the price for an earnout? Earnouts are when the price is increased if the sales after closing meet certain agreed targets. Buyers like that. It's a way of adding an extra, adding to the price without necessarily taking on a great deal more risk. And then lastly, perhaps equally important to all these points, is what role will the seller have in the business after closing? Sometimes the buyer will want the seller to stay on in a purely consultative role. Sometimes the buyer will need the seller to transition clients and transition relationships. And other times, the buyer will be interested in being a co-owner with the seller. But all of those options require some careful consideration and of course, planning. Those are my comments on the planning aspect. And now I'd like to turn it over to Morris to talk about the process for a successful M&A transaction.
Thank you, Michael. Good morning or good afternoon to everybody, again, depending on where you are. So I've been asked to discuss process in the context of buying and selling a business. And needless to say, the process is one of the most important components to consider when embarking on this journey, because poor planning, as Michael said, can lead to many obstacles along the way. There are several steps that must take place. I like to break them down into 5 steps in order to successfully get to the finish line on a transaction. So as Michael alluded to, there's the preparation phase. There's the market phase, the what I like to call the pre-contractual phase, the due diligence and negotiation phase, and then finally the transition phase. And some of these items have already been touched upon by Mark and Michael, but I think it's important to sort of break them down by components of the process. So when we're looking at a preparation phase, when we're dealing with a transaction, as Michael said, engaging a proper advisor or group of advisors, be they investment bankers, a business advisor, evaluator, and of course counsel, leads the process, who may lead the process. I think you'll put yourself in a better position to either acquire or sell your business if you surround yourself with a good team. And it's vital to the process. There's also the psychological aspect, as has been alluded to throughout the talk today, of understanding, for the advisors to understand the business and the psychology of the transaction as to why someone wants to sell or purchase a business. I found from counsel's perspective that once engaged, it's imperative to meet and speak to your client and have a frank discussion about what the end game is and what the client is looking for. Are they simply cashing out? Are they going to continue to stay in the business? And what vendor, what purchaser are they necessarily looking to align with? Are they looking for a strategic alliance? Are they looking to absorb a competitor, etc.? And I like to stress at the preparation stage, not only is it important to make sure, as Michael said, that the corporate structures in proper condition, but it's also important to engage a valuator, even in a small business, to understand and to plan and strategize what the value of the assets or business is, and in order to see what price you can reasonably ask for and what price you may reasonably expect. Once that's done, I guess we get to the market phase, and the market phase can certainly take several different aspects. There's several different aspects to the market phase. A client could go out there and simply engage the advisor and tell the advisor to go out there and find potential purchasers. And conversely, a buyer could say, well, find me a business that looks good, and we'll take it from there. I'd like to throw in an example of a transaction I recently worked on where my clients have been involved in the business since inception over 40 years ago, and they were looking to sell the business. And when we sat down with them after they sort of prepared the business, because of course they had met with us 3 or 4 years earlier in order to make sure that they were properly tax planned for optimal tax treatment on a sale. The client made it clear to me that they don't know necessarily what the price of the business is or what they think they should get at the end of the day. They had an idea, but before even looking at a valuation of the business, they said, well, we really want to sell to our employees. We'd like to look to management to buy us out. And I couldn't really understand why, because the management group didn't seem to have a lot of money. And they said, we're interested in selling to our management employees because we feel a sense of loyalty to these employees. They've helped us build the business. They've also helped us build our own individual wealth. And on top of that, they felt that if they were going to deal with their own employees, they would be assured that the company would remain in Montreal and that the employees would remain employed in the province of Quebec. And this was very important to these clients, notwithstanding the fact that the potential suitor didn't have what I considered the financial means in order to buy the business. So at that point, we prepared a teaser, as Michael said. We sent that teaser out to strategic customers and clients, and it was a small group. And once those, we received some expression of interest from those particular people that we targeted and had a non-disclosure agreement executed with each of them, we met. We met with each one of the potential purchasers. And the client sort of asked very pointed questions. And at the end of the day, we concluded a transaction, as you can probably guess, with management, because notwithstanding the fact that we had all sorts of interest from these other clients at very substantial purchase prices, the client decided, well, no, we are not going to sell to somebody who's just going to close down the business in Montreal. We're going to sell to our management team. So, as I said, there's many ways you can market. That's one way to market, and it certainly was successful, and everybody was happy at the end of the day. Next phase, as I pointed out at the outset, is the pre-contractual phase. So when I speak of pre-contracts, I'm talking about executing non-disclosure agreements. This is usually the first document executed by parties interested in concluding a transaction in order to exchange initial information. So you will typically sign a non-disclosure agreement with a potential vendor in order to get financial statements, or to get a list of employees, or to get a list of certain customers that they are dealing with. Thereafter, buyers would typically decide if they're interested in pursuing the transaction to prepare either a letter of intent or memorandum of understanding. Clearly, depending on which client you're representing, the question will be, is this document going to be binding or non-binding? And the key goal of these agreements is to outline the prospective business relationship between the parties, and you may not necessarily be combined parties. So what you're trying to do with a letter of intent or non-disclosure, letter of intent or memorandum of agreement, memorandum of understanding, is to attempt to commit to writing an expression of common interest to enter into negotiations with a view to reaching a definitive agreement. You would like to have something as a vendor clearly, which would be more binding than non-binding, because if you're going to take your business off the market and pursue a potential transaction with a purchaser, you'd like to know that ultimately they're going to proceed with the transaction. As a purchaser, you'd like to keep that document as open-ended as possible. You might want to just sign something that then leads you into a relatively robust due diligence process, which you hope will culminate with a binding agreement. There are really no standard forms when dealing with these pre-contractual agreements. I'm often asked by clients what are the benefits to using them, and I guess, in my opinion, there are several advantages. As I mentioned, it delineates what each party wants to get out of the deal. It intends to at least settle basic business terms at a very early stage, and to outline what those terms will look like in definitive agreements. And it creates, quite frankly, an honest and open exchange of information and lays the groundwork for how items will be exchanged. And also, establishes a tone for future negotiations and protects each client's information and interest. I'm often asked why do it, and I feel that it does ultimately reduce transaction costs and expedites the completion of the transaction. If I were to look at reasons why not to execute these pre-contractual agreements, it may be, and just move into the negotiation and execution of definitive agreements, the parties may be limited as to timing. There may be a risk of unintentionally binding parties, and to be quite frank, it's sometimes the parties don't want to incur additional fees that are required in order to execute those pre-contractual agreements. Once the letter of intent and memorandum of agreement, memorandum of understanding, the pre-contractual phase is completed, then we can move into the due diligence and negotiation phase. What I like to do at that point is to sort of reach out as an attorney to vendors counsel and have a kickoff call. I just had two this week, where you sort of introduce yourself to opposing counsel. The clients may or may not be involved, and you sort of discuss, okay, where are we going? What sort of timeline do we need? And how are you going to get to the finish line here? And right after that call, what I've been doing over the last couple of years is I've been drafting a timeline document, which you might say again increases costs, but in fact I feel at the end of the day saves the client's money. So it's another document that sort of looks like a calendar. It's based on the letter of the timeline provided in the letter of intent or memorandum of understanding, and sets forth on a calendar key moments in the transaction and the upcoming transaction. So it might state that a due diligence checklist will be provided by the purchaser and sent to vendors counsel on a certain date. Then it'll provide for a fixed time limit within which to respond to that due diligence checklist. Obviously, these items are fluid and need not be binding, or these dates need not be binding. However, it does sort of place the onus on the parties and counsel to move the process along, to supply the information in a timely fashion, and to accelerate the process, or to at least get people in the mindset that ultimately, we've got to do this transaction on a timely basis. Thereafter, we might set timing for preparation and drafting of a closing agenda or a share purchase or asset purchase agreement, as the case may be. Once that so let's look at the due diligence checklist. Once the due diligence checklist is sent by purchasers counsel, it's important, or actually I'll take a step back. Prior to sending the due diligence checklist, if you're representing the purchaser, I have found that it's important to sit down with your client and sort of understand what legal, non-legal, and business items they're looking for in order to properly assess the business. So do they want to see customer accounts? Are they looking at union contracts? Do they want to see the top, the top 10 customers, etc.? And that sort of assists the purchaser in preparing a due diligence list that makes sense for the particular transaction. Conversely, when I represent vendor, I find it's helpful once I receive that list to sit down with the client and their financial advisors in order to work in concert to prepare all information requested and provide same in a timely manner. And as during the due diligence period, I also can't stress enough, as I believe Michael mentioned, that it's important to reach out to your financial institution or lenders in order to ensure that you can obtain the proper financing for the transaction, so that during the due diligence period or at the end of the due diligence period, if you so desire, you're able to move forward quickly. I've often found that, depending on how quickly the clients want to transact, during due diligence period, during the due diligence process, the parties may want counsel to begin to prepare the transactional documents. So whether you've gone through due diligence and are satisfied, or whether you want to do that in parallel or prepare definitive agreements in parallel to the due diligence process, transactional documents are typically prepared and exchanged by the parties. So that can be the actual purchase agreement, the earn-out agreement, the bonus agreements, etc., and various employment agreements that need to be drafted. Once that has been done, and once the documents have been exchanged, I find that it's important to meet and determine what key stumbling blocks need to be overcome in order to get the definitive agreements settled. I often get upset with young attorneys in my office who rely on technology in order to send markups or comments on documents back and forth, without actually sitting across the table with the purchaser or vendor, as the case may be, and actually dealing with the issues. I think it's important to actually sit down and have a face-to-face meeting in order to finalize the process. It provides clarity to each party. It sees where they are going and what issues remain to be overcome. So assuming you overcome them and you've had a successful negotiation, I guess I have often found that it's important to have a closing, have a face-to-face closing, which again, people don't necessarily like to see today. Certainly younger vendors and purchasers don't like to do things face-to-face. They like to use technology. I like to sit down with the parties in a boardroom. I like to ensure that there's been, as Mark said, everybody, it's a win-win situation for everybody. Parties get to sit down, they thank each other, they shake each other's hands, a check is usually exchanged. And I feel that goes a long way towards ensuring a successful and seamless transition of the business. And finally, the transition phase, as I alluded to earlier, but I see I'm running short on time, it's important for the parties to sort of sit down and together, purchaser and vendor, preparing public disclosure or documentation that is necessary to be sent out to employees, customers, etc., in order to ensure that the transition of the business happens seamlessly. So I guess with that, I'll turn it back to you, Michael.
Thank you, Morris. Thank you very much. That's very helpful. As we've all talked about, it's so important to assemble a good team. And as accountants, you'll certainly be at the heart of those discussions, because if you're close to your clients, you'll be talking about the financial aspects, the tax aspects, and legal counsel matter as well. I think it's important to talk to your clients about what they're looking for in counsel. When we sit down and talk with a prospective client, we ask, what are you looking for? Everyone has their own experiences, and it's important that the fit that there be a good fit and it be appropriate. It's also important for legal counsel to be nimble and flexible and efficient. Every transaction is different, and yet there are common themes in all of them. We've talked about those things. But it's important that there isn't just one way to deal with it. The clients have their own objectives, they have their own approaches, and that needs to be really the starting point for any discussion about how to approach it. And there has to be an understanding. I want to pick up what Morris mentioned a moment ago about sitting down and talking with people and clients about what is their objective, what are they looking for. That's an essential element. So that at the end of the transaction, because these deals can gain a certain momentum of their own, and suddenly everybody's rushing to get all these things done for closing. But the worst feeling of all is when the seller or the buyer finishes the deal and then wonders, oh, gee, was that really the best decision? So it's so important at the early stage to work with people who understand and want to understand what their goals are. And to always have open communication, because that's very important in making sure the deal is on track. I want to move now, in the time we have remaining, to some questions that we've received. So one of the questions that comes through, one of you has submitted, has to do with the buyer being certain of the valuation being accurate and how to make sure that it's accurate. We also had a question in a similar vein before this about asking sellers might be hiding revenue. How do we know the true story or the real financial perspective? And it's a great question. And I think while none of us on the panel are evaluators, it's very important in the process when you're acting for a buyer and also acting for a seller, but to realize what is the true income or true profit of the business. Often with businesses, private businesses, expenses are paid perhaps a little more informally, and maybe that's a generous way to say it. Sometimes personal expenses are paid. Sometimes if it's a family business, salaries are paid that aren't linked to the true fair market value, or maybe would not be appropriate. So it's very important to get a sense of what is the true income of the business, because that's usually the marker against which the price will be set. So what does the buyer do? The buyer needs to dig deeply and to understand that in most private businesses, there are some expenses that are in there that are not appropriate, maybe in other contexts, and certainly with different owners. Mark or Morris, do you have anything to add about that? Trying to get from a buyer's perspective, trying to get to the bottom of the real value?
Well, I had a surprise recently in a file where I was representing the seller. So we worked through due diligence, and we provided financial statements and financial information as was required by the purchaser, and then found out at the end of due diligence that basically the client was not really comfortable with the reporting, and so they said, look, we're prepared to proceed further, and we'll extend our delays, but we'd like you to now engage a financial accountant, a different accounting firm in order to audit the statements. And that was quite a dilemma for the vendor, because I don't have to, for those of you out there who prepare audited statements, you know that there is a significant cost in having that done. We ultimately did it, and the purchaser was then happy, and we went on, and the transaction closed. But you're right, Michael. It is important to sort of go through the process carefully when evaluating a business in terms of what you can, what the client will be satisfied with in terms of a purchase price.
Okay. All right. And then another question that's come, and this is a great question. How do you assess from the outside as a buyer the culture of the business that is going to be bought? And what do you look for during due diligence? That's a great question. I think culture is what goes on in any organization when nobody seems to be looking. It's the informal habits that people have and how they treat each other and how they treat their jobs and their responsibilities. It's tough in a due diligence setting where the buyer is trying to present the best picture possible to really understand what's it like to work there. And I've certainly been in cases where in a deal, the buyer, we're acting for the buyer, and the seller is telling us that this employee is really not performing well, not somebody that should be kept. And then after the transaction closes, the buyer finds that actually this person is a great member of the team. It just wasn't properly managed. So it's difficult for the buyer to get under the skin of the target company and understand whether the seller has the culture that he or she presents. I think the best thing, though, is to spend time, and it goes back to a comment that we've made before, to spend time understanding the business and trying to see how people interact and get a sense of how the business has developed and how people are treated. That's very important, and culture matters, because if it's not the right cultural fit, then the transition and the integration will be very challenging. Mark, did you want to comment a little bit on that, how to find out what the culture of a target company is like before the deal closes?
That's a very difficult issue to address, because it's almost impossible to find out what's actually going on in a business. The only way that you might have some access to that, and it's always a difficult debate, is at what point do you allow interviews to begin? There's always this tension of keeping everything confidential, because you can't let too many people know what's going on. But as a buyer, wouldn't you love to speak to the top managers and get their sense of what's happening, get their sense of what's happening in the industry, and also to validate your decision to go ahead and purchase something? And I've had the full range of requests from buyers to get in and talk to employees, and as a vendor's counsel, you always resist that. So that's really the only way that you can dig a little deeper, is getting in and doing some further due diligence.
Thanks. Thank you, Mark. One more question we have time for, and this is another great one. In your opinion, our opinion, what role should accountants play for clients who are planning to sell their business, besides assisting with providing information to prospective buyers and consultants who are assisting with the sale? I think that's a fantastic question. It's a question for any advisor. And I think the answer belongs at an earlier stage. I think it's important for all advisors, lawyers, accountants, and others to, in addition to helping clients with their day-to-day needs, try to encourage them to think about the broader strategy of the business. We like to sit down with the business owners regularly and ask 3 questions. What's going well in the business? What's not going well? And where do you see yourself in 5 years? And we find that asking those 3 questions typically penetrates to the heart of what's really going on in the business. And business owners are often challenged by running and having hectic days and dealing with challenges and seizing opportunities, and they don't have an opportunity to think of the broader picture. What will they be doing in 5 years? How will this business develop when down the road? And how will they exit from the business? Ultimately, everyone exits. So I think the role of an advisor begins with gently and persistently prodding the owners to talk about the future of the business and how will it look like. And I think accountants can play a great role in that, as well as other advisors. And so having that broader strategy, I think, is a great advantage to the clients as they begin to plan and have a sense of what exactly they're going to accomplish with the transaction, and not simply be drawn into something because they get an attractive offer and they think that's the best opportunity. So I want to thank, our time is run short now, but I want to thank everybody for participating. A special thank you to Mark and to Morris for being part of our panel today, and to the ACCA for arranging this and coordinating it, and also to the listeners. We appreciate everyone participating, and we hope that we've been giving you some practical guidance, and look forward to, if anyone has questions, they can certainly forward them to the ACCA, and we'd be happy to discuss further. Thank you, everyone.
And thank you, Michael, Mark, and Morris, for a fantastic presentation, and for all of you who joined us today. In a moment, you will be prompted to answer a survey, so if you could kindly take a moment to fill that out and help us inform our future webinars, we would really appreciate it. Thank you all, and enjoy the rest of your day.